Good morning and welcome to Charting the Markets on Tuesday, the 26th of September. Yesterday evening, the hawkish Fed member Kashkari said that in his opinion, the Fed should hike its rates one more time by 25 basis points. And that has led to further strength in the US dollar, even though the US dollar has already risen for 10 consecutive weeks. It also led to a rise in US Treasury yields, especially on the long end, and basically led to risk-off sentiment with regards to equity indices and these coming down. And we'll look at these in a minute. And basically what is also of importance at the moment is that US lawmakers are trying to avoid a shutdown in the future. And that also worries investors that this could potentially happen once more in the coming weeks. And with regards to the economic calendar, there isn't really much happening today. At 3 p.m., we've got US new home sales out for August and also consumer confidence for September. And we expect home sales to fall, obviously, since these rate hikes over the last few months and year basically have led to the financing of a new home becoming far more expensive. And consumer confidence is also forecast to weaken. So let's begin by having a look at Asian markets for once. And we can see the Nikkei 225 here coming off. And this daily financial bet is showing us that the Nikkei, even though it tried to rise yesterday, gave up all of its gains and is heading back down again towards last week's low, around 32,168. That is potential support. But if that were to give way, which looks pretty likely at the moment, we could once again be heading back down again towards the July lows and early August lows, which go down to 31,682. So that's for the Nikkei 225. Now that we've risen, fallen, through this August to September uptrend line, and that a possible retest of it on Monday of this week failed just below that now because of inverse polarity resistance line. So further downside likely to be seen with regards to the Nikkei 225. And in the UK yesterday, we saw the FTSE 100 finally fall through its 200-day simple moving average here in red at 7,648 and dipped down to 7,581 on this daily financial bet. But earlier this morning, even though we retested the lows, we tried to head back again towards that 200-day simple moving average. So we'll have to see whether we can hold above yesterday's low at 7,581. As long as we do, we could see some short-term stabilization take us back towards 7,700 on the FTSE 100. But for the bulls to really be back in control, what we need to see is a rise and daily chart close above the current September high at 7,747, which looks to be pretty unlikely at the moment. So what does that mean? Well, if we were to fall through yesterday's low at 7,581, then we've got some support coming in here at the August to September uptrend line. It's actually just the September uptrend line. And that can be seen at 7,536. And also here, the orange line, the 55-day simple moving average is 7,520. So that's a potential support area for the FTSE 100. And basically, from a medium-term perspective, provided we stay above the last important reaction low, that is to say a low which is lower than the one on the candle to its left and to the right on the daily chart, in this case here, the 6th of September low at 7,369, provided we stay above there, further upside medium term seems to be in store. But yes, the last week or so of September, quite often from a seasonality point of view, leads to lower prices. So I wouldn't be surprised if we were to retest Monday's low and perhaps slide a little bit further before we stabilize again. And you can see the same happening basically in regards to US markets. But here what we see with the Dow Jones Industrial Average is that since the mid-September highs, we've had 8 consecutive days of losses for the Dow Jones Industrial Average. And that took us back down again towards this red line here, which we tested yesterday and which has so far held. And that's the 200-day simple moving average at 33,823. So yes, the Dow is trading at levels last seen in July of this year, but short term at least, we may today bounce off this 200-day simple moving average and recover slightly. So how far could we recover? Well, we could retest the late August low at 34,025. And above there, we've got some pretty decent resistance between the 34,263 May high and the 34,286 low seen on the 6th of September. So that's really important resistance going forward. Provided we stay below that, further downside might actually be seen once we've seen that minor potential bounce. Now, if we were to fall through yesterday's low, which was made at 33,779, the next downside targets would be the late June and July lows between 30,610 and 605 for the Dow Jones Industrial Average. And if we also look at the Nasdaq 100, here the descent has been less brutal, but we have still come off since our mid-September highs. As you can see here, just red candles all along, but you can see a loss of downside momentum. And so far, we seem to be holding above yesterday's low at 14,620. And yes, that was a level last traded in mid-August. And the key support area to look out for here is around the August low at 14,554. Provided we manage to stay above there on a daily chart closing basis today, we might see a minor bounce back, take us back towards the 15,000 area or so. But even then, we're not out of the woods. Basically, as long as we stay below the breached March to September uptrend line, which now because of inverse polarity acts as resistance, the odds favor further downside to be seen with regards to the Nasdaq 100. And if we were to fall through this August low I just mentioned at 14,554, there's nothing really stopping us from declining all the way down towards the red line here, the 200-day simply moving average, 13,586. So basically watch these key support levels on all these major markets I've just mentioned very closely, because a daily close below them could actually mean that further acceleration to the downside could be seen over the coming days and weeks. The US dollar, after having risen for 10 consecutive weeks, got another boost yesterday by hawkish Fed commentary and by the yield of the US treasuries basically rising to levels last seen in 2006 and 2007. And I believe the 10-year US Treasury yield actually rose above 4.5%. That's topping its 2007 high. And on the back of that, you had further strength in the US dollar. And if you look at euro dollar, because the euro makes up 57.6% of the US dollar basket, you can see the inverse of that. And basically, we dipped down to 105.70, a level last traded in March of this year. And you can see here that we're now approaching some really crucial support. And this is made up of the January and March lows between 105.16 and 104.84. And so far, as I said, we've dipped down to 105.70 on this dated financial bet. But we remain within this downward channel, and it's a very clearly defined downward channel. And basically, provided we stay below the last reaction high, that is to say a high which is higher on this daily candle above the one to its left and to its right, in this case, the high seen last Wednesday at 107.36, provided we stay below there, further downside seems to be in store. Even if short term, we might get a little bounce, perhaps take us back to the May low at 106.36, but that could already act as resistance going forward. Moving on to another currency pair, what I also find interesting at the moment is the euro versus the British pound. We can see here that we are flirting with the high seen back in July of this year. And we do so as the German 10-year Bund yield surged towards the 280 level. And this is the highest level since July of 2011. And it looks to me as if we could actually overcome this 87.01 high on this currency pair, which we made in July, and test the red line, the 200-day simply moving average at 87.12. Now, that might act as resistance together with the 11th of May high, which was made at 87.34. And as long as that caps, we may then sort of come back into this wide sideways trading range we've been in since June of this year. But if we were to manage to rise above 87.34, then we are probably leaving this sideways trading range and are heading back up again from a longer term perspective into the previous sideways trading range, which if you go back to the beginning of this year was happening between the sort of 90 area and the 87 area. So we would enter a new trading range again with regards to euro sterling, but it hasn't happened yet. As I say, we need to not only take out the July high at 87.01, also we need to overcome the 200-day simply moving average at 87.12, and ideally also the 8th or the 11th of May high at 87.34 for this scenario to become more plausible. Now, I also would like to have a look at the Chinese yuan. As you can see here, the US dollar versus the Chinese yuan rose to a very important high at 736.81 last week, and that was made just marginally below its all-time high made in October of 2022. So it's no surprise that we are consolidating below this key resistance area. And what has happened since is that we have come off on some stronger data out of Japan over the last few weeks. But since the low seen in mid-September at 725.96, we've actually been grinding higher again. And that was on the back of the US dollar strengthening even further. So here the upward momentum in the US dollar is less pronounced than it is, for example, against the euro or the British pound, but it is still visible on this chart. So from a technical perspective, if we were to rise above last week's high at 732.14, we could then perhaps head back again towards the August and the September highs between 735 and 737, roughly speaking. The strong US dollar has had a negative impact on some commodities, but others have actually continued to rise, and one of these is the US crude oil price. And you can see here the price of crude oil, interestingly enough, rose by about 16% from its late August lows to its high seen in mid-September at $92.38, despite the US dollar continuing to head higher. Now, what has changed over the last few days is that US dollar continues to head higher. So as I mentioned before, we basically have seen 10 consecutive weeks of higher prices for the US dollar basket. And here now what we're seeing is actually the price of WTI consolidating below that one-year high. And that high at $92.38 was made marginally below the October and November highs of last year between $92.70 and $95, which still represent key resistance. So the trend is not over. The medium-term trend is still pointing higher. Yes, short-term, these higher yields and this scenario of rates staying higher for longer and the negative impact this might have on the economy going forward has led to demand worries with regards to crude oil and also to the price of crude oil consolidating slightly. But we are, in my opinion, just in a sideways trading range and basically remain in it as long as we stay above the 8th of September low at $87.46. So whilst we're above that last reaction low, even though it's a small one, I expect further upside to be seen in the coming weeks, provided we continue to range trade and trade sideways instead of falling even further and taking that low out. But for now, we're just seeing a consolidation in a strong uptrend. Moving on to silver, the price of silver is also looking quite interesting because here what we've seen is that the stronger US dollar this week at least has led to a pretty sharp sell-off in the price of silver. As we can see here, we've come down from last week's high at $23.77 and have fallen through the red line here, the 200-day simple moving average at $23.48, down towards last week's low at $22.82, where we have found support so far. Provided that support continues to hold, we could just trade sideways and we may actually head back up again towards the 200-day simple moving average and this August to September downtrend line. But if we were to fall through $22.82, the low seen last week, we would be heading most likely back down towards the lows seen since June of this year between $22.30 and $22.12. So basically watch that low from last week because that can give us a good indication of what's likely to happen next. Provided it holds, we could see a minor bounce back. And if it were to be fallen through, we should see some follow through to the downside. And last but not least, I'd like to mention sugar. And basically, as we can see here, the price of sugar, which last week hit a 12 or near 12-year high at 27.85 on the front month futures contract. Here, number 11 sugar futures have actually come off and fallen through this steep accelerated uptrend line, which interestingly enough, and markets quite often do that, they retest a breached uptrend line, which then acts as resistance, as you can see here. So the high seen on Friday failed at that previous uptrend line, which was broken through, which now acted because of inverse polarity as resistance. And since then, we've started to come off. But what is interesting, and this is why I wanted to show you this chart, is that because we have fallen through and closed below the last reaction low, that's to say a low lower than the one to its left and to its right, and that was made on the 18th of September at 26.71, because we closed below there, that to me shows me that a top is probably in place, at least short term, and that we could slide further in the days to come, perhaps back down towards the highs seen back at the end of June. And these were made at around $26.21. And below that, we've got potential support around the $26 mark as well. So it's likely that we're going to see some further downside short term, at least with regards to the price of sugar. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X, formerly known as Twitter. My handle is @AxelR_IG.